So arbitrage is nothing but, by academic studies, it says that it is a riskless profit.
Can you explain to our viewers why is there a difference between the prices in these two markets?
The difference between equity and the futures market is basically a play on the interest rate.
During the month, what are those drivers that would lead you to change the positions or square off?
If there is a volatility or there is a supply-demand mismatch which creates to the differentiation in the spreads, you actually have the opportunity to enhance your profit.
Hi everyone, welcome to the 7th episode of Fundamentals. I'm looking forward to speak with Mr. Shailesh Jain, Fund Manager of Tata Arbitrage Fund. He has been successfully capturing the difference between cash equity market and futures market while staying 100% hedged at all points in time in a very disciplined manner. Also adding to the returns via riding on volatility during the month. Hi Shailesh.
Hi.
Welcome to the show.
Hi Shaily, thanks for having me here.
Yes. So like we started that there is a difference in prices between the cash equity market and the futures market. To set the context, right, why do you think is there a difference? Can you explain to our viewers why is there a difference between the prices in these two markets?
Right. So let's understand what arbitrage is all about. So arbitrage is nothing but, by academic studies, it says that it is a riskless profit, which means that if you can buy, in a very nutshell, in a very layman example, that if you buy a mangoes in an X market at an X price, you can sell the same mangoes in a Y market at making some profit. So basically the underlying remains the same, which means the mango. So you're buying at an X price and you're selling it at a higher price in the Y market. This is what an arbitrage is all about. Arbitrage funds for an Indian context are slightly different. Here what we capture is basically we go long on the cash equities and we short the futures. So basically if you understand, the prices of the futures are determined by the underlying of the same script, which means that if you're buying a Reliance equity shares and you're selling the Reliance futures, so the underlying remains the same. The difference what you capture basically by buying cash and selling futures, the difference is what is called spread or the cost of carry, and this is the profit what you make when you do this trade. The good part that at any point in time when you initiate this trade, the position is completely hedged. So this is what the arbitrage trade is all about. Now there are questions raised that why is there a difference? The difference between the equity and the futures market is basically a play on the interest rates. Now the logic is very simple, that anybody who would have gone long on an equity shares would have actually put 100% of the capital to buy the equity shares, whereas when you trade on the futures, you are actually only putting up margin to go long on the equity. The long guy is actually compensating the short guy for providing him the trade or providing him the shares in the futures market. The money which he saves will be put into the bank, which earns an interest for the month and which he will pay at the expiry day. So basically the difference of the money which is kept in the bank, the interest earned on them, is basically the cost of carry. Now because you are in an emerging market and there is a demand supply mismatch, the spreads can actually differ slightly more than what the bank interest rates are all about, and that is why you have the cost of carry, which is slightly different from the bank interest rate. It could be higher and at times even trades lower. The reason is there because you are in an emerging market like India, where there can be supply mismatch between a stock, and that could lead to the difference in the cost of carry.
Interesting. So that brings me to understanding from you better the sources of returns in this fund. One part, as we understand, is the spread, which is the rollover spread that we talk about in normal parlance. And let's say a portfolio has been rolled over to this new month, the spread has been locked in. Now during the month, what are those drivers or what are those triggers that would lead you to change the positions or square off riding on volatility basically?
So thanks, it's an interesting question. So let's understand that what happens in this fund when we put a trade, right? So on the day one when you put money, the first trade what we do is we'll be going long on equity shares of an X share and we'll be selling the futures of the same underlying, right? So theoretically you have locked in your trade, your position is completely hedged. Now how will you realize your profits? On the expiry day, in a normal circumstance, on an expiry day, your futures will expire. Since we have physical delivery, which means you will have to give up the delivery for your short shares. You already own the equity shares, you will give delivery to the exchange and your trade is squared off. Now this is the normal trade where your profit is realized. in a practical world, what happens is that there is instances where you will let your futures expire and you will give the delivery, or you will roll over your position from the current month to the next month. So let's take example that you are in the month of September, and if the expiry of the September comes at around 30th of September, what you will do on that day, either you will square off your position or you will roll it over. Now, how will you roll it over? You will square off your existing futures position, which means the month of expiry of September, and you will sell the October series. So that means your position, how will your position look like at that point in time? You will be long equity shares, and you would have sold the October futures. So that is how rollover. Now the difference between the September series of the futures and the October is what you will capture as your profit for the next month series. Now this is what happens on a rollover. There are multiple instances, as I told you, the demand supply mismatch can happen, which I told you just earlier. There can be a change in the spread, which means that the spreads can actually widen or compress. Now time when the spreads compress, you actually have the opportunity to enhance your return by squaring off that trade during the month rather than waiting for the expiry and actually redeploying the same money into another trade which is trading higher than what you have squared off. So typically what happens is that if there is a volatility or there is a supply demand mismatch which creates to the differentiation in the spreads, you actually have the opportunity to enhance your profit in conjunction to what you have already locked in the spread.
What are the highlights of Tata Arbitrage Fund in terms of clocking performance?
So what has also led to our outperformance is basically we have had a portfolio approach in managing our funds. And what I mean by that is that for me, if I really put into a stock, what is really critical is that to find a difference or to look into the market cap where I'm deploying. So what I mean by that is that there could be a large cap, mid cap and small cap, as everybody knows. Large cap is for the first 100 stocks, mid cap is basically anything from 101 to 250th stock, and anything below that is a small cap. Now for me, what is critical is to understand that which market cap is in action now, which means why? Because one, it ensures that there is liquidity into that part, and second is the cost of carry is better in that particular market cap. Higher the action in that, basically that leads to movement in the cost of carry or the spread during the month, which means I can exit my position early and reinvest. So that is very critical when I look at investing into a particular stock as far as the ARB is concerned. The second thing what I look at is also the sector and the stock which are in focus. So for me, I have to ensure that I get always deployed I deploy most of my money in terms of the opportunity into sectors or stocks which I personally believe will be more volatile or where there is more action during the month. Again, similar reasons. If I am invested into a stock which is more in favor or in action, one, the cost of carry is higher, or I get an early exit during the month, which means I can reinvest my capital thrice in the same month and enhance my return. The third most important part also is the corporate actions, which means the dividends. It could be either mergers, it could be rights, or it could be bonuses. The point is that these are the opportunities which don't come regularly, but they come once in a quarter. Or so if your assessment of a company is right by looking at the cash flow or the balance sheet or the businesses, and if you can assess correctly the amount of dividends which it will be paying, and if you are putting in a trade which is a hedge trade, which means you are completely hedged, your equity shares is hedged with the future, that dividend earning of the stock is actually an added profit to you, and that enhances your return. This is how the differentiation for us versus the peer is all about.
So market cap movement across market caps, identifying stocks which where the spreads could have narrowed down, and corporate action. These are the three sources of returns apart from the rollover spreads that you mentioned. Interesting. This category of arbitrage has equity taxation, and the return profile is close to debt, if not exactly debt. Maybe sometimes it could be higher, sometimes it could be closer to debt. How do you want investors to look at this category, look at this fund?
So you're right in that an arbitrage fund is an equity fund for a taxation purpose, which means that if you hold this fund, For more than a year, you are taxed at long term. If you hold less than a year, you are taxed at short term. Where and to put it simply, that every position in an arbitrage fund is completely hedged, which means that if you put it that way, the return profile is more or less similar to a liquid and ultra short fund, and the risk associated with also is very similar to what you see the liquid fund and the ultra short. So the point, what I'm trying to say is that when your return assumptions are very similar to what you see with the funds which I just named, there is always a tax advantage with an arbitrage fund. So in practice or in theory, anybody who's looking for a sustained long-term linear type of return, then maybe arbitrage fund generally stand tall versus the named debt funds.
So that brings me to a point that there are so various market phases, and you could have strong markets on the upside, strong market on the downside, volatile times, prices rising, but there is something called as open interest, which we keep hearing from you, and in this space especially. So can you help us place how arbitrage funds do across various phases?
So that's a good question. I think what is critical, that arbitrage fund in general is an all-weather product, if I really put it that way. Why? Because this fund does quite well when the market does quite well. And why I am saying is that, just imagine that if the market is doing very well, you will have real good new set of investors coming in, who will actually would typically could be more leverage buyers who want to buy in the futures, and generally are ready to pay a higher cost of carry on the future position, because they believe that they may make good profits on their holdings. So in a bull market, generally the cost of carry or the rollover spread generally goes higher, and the arbitrage fund generally enjoys a better return. In a volatile market, or a scenario where market could be trending, but there could be some intermediate corrections because of the valuations, those are also again a very good market for an arbitrage fund. Why? Because during those periods you will see a lot of sector rotation, you will see new fresh set of investors coming in, old exiting, booking profits. This will lead to significant volatility, sector rotation, stock rotation. Again, as I reiterate, that because we are completely hedged, any movement from an X sector to a Y sector gives an opportunity where the spreads can expand and compress, and this is an opportunity for an arbitrage fund, wherever the spreads compress, and if we are holding that particular stock in our portfolio, we will exit that and reinvest into stock or spreads where the spreads have actually expanded. So that's an expanded. Bear market, where you may see some amount of value correction coming, a 3, 4, 7% correction for 5% correction, is again not a very bad market to invest in an arbitrage fund. Again, opportunities are there in the market. What is really bad is basically where we see a sharp fall in the Nifty, anywhere close to 20-25% of fall, is where we have seen where could be a slightly a bearish, where could be a bad market to invest into arbitrage. But those kind of scenarios have just happened twice, at least if I have seen in last 15 years or 10 years. One was global financial crisis and the second was COVID. But that period remained for a very brief period, basically not more than 10 days, 15 days, when spreads were very tight or were very low. That was the case. But on a 3-month rolling basis, even if those period, I think arbitrage funds in general, the category has done well. Even if I include those period from the global financial crisis to COVID on a 3-month rolling basis, the returns have been quite they have been in line to what has been the averages. So
interesting. That is how the fund category becomes so interesting. Happy selling, everyone. Tata Arbitrage Fund. The category itself is the best of both worlds, attracting equity taxation, and as we understood, the return profile is close to debt. It's safer. The spreads are locked in. While the spreads are locked in and it is 100% hedged at all points in time, the FM also adds on to the returns through the month by capitalizing on the market cap movements in the market, by capitalizing on the stock price movement as they move from futures, from premium over the cash market into the discount zone and back to the premium, and also by taking cues from the corporate actions. So here's an interesting category. Thank you, everyone.
Mutual fund investments are subject to market risks. Read all scheme related documents carefully.